Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates, and 10-year note yields continue to inch higher. Not seeing the big move that we saw earlier this week, but 10-year note yields eclipsing 310, level not seen in probably close to 7 years. So we are kind of entering that area, that sort of that unknown, uncharted territory, we'll call it. And recall yesterday we talked about volatility being bid as we traded outside of the range, outside of the comfort zone, expectations, whatever you want to call it. Today we're seeing volatility, a slight trade sideways. So the market seems to be finding a home here just north of 310. But like us, how high could they go here in the short term? And right now, looking out to the next moment for the bond market, without any surprises coming from somewhere in geopolitical land or some kind of economic data that throws the market off, we're probably looking at a target of 3.25 by June FOMC, 3.25. So we do have a little bit of a ways to go, but we're obviously that could be the level where we start to see a pause ahead of June FOMC, with the Fed chairman giving his press conference may give an indication of not only how hawkish or dovish policy could be in the second half of the year, but perhaps the Fed may want to tweak its balance sheet unwind if there's good demand for 10-year note yields at current levels, and with the supply coming to market, they may look to add to it as well. Maybe not. Maybe they look to pull back to make room for that Treasury supply that's going to be coming to market. So right now in the short term, we're targeting 3.25 yield over about the next month. And volatility, as I just said, kind of trading sideways here. So market not seeing any real need to price in fear or angst, but definitely seeing it higher, holding at higher elevated levels. Nothing that puts the RPM dial in the red, though. So Treasury volatility remains elevated but low historically, given the move we've made. And lastly, let's look at the curve, Treasury curve. Yeah, 2s10s has steepened about nine basis points here since this move. However, if you take a step back, it's still really only an inch on a yardstick to show you the move it's made. And just, the market is still pricing in fear of inversion, despite the fact that we are seeing a modest steepening here. And that is going to be something that the Fed will address at the June FOMC if we don't hear it before. We've heard some Fed speakers over the last week talking about inversion, and there's been kind of this idea that it'll be an inversion put. The Fed won't allow the curve to get inverted. And right now, with 2-year note yields nearing 260, we're seeing a pause in 10-year note yields hovering at around 310. So we do definitely need to see 10-year note yields continue to creep higher, or we need that 2-year note to back off if we're gonna kind of stay away from that inversion talk that got so prevalent when we were trading in the mid-40s on the 2s10s, now north of 50. So right now we're seeing the curve telling us that, yeah, there may be a start. We may start to see this get back to normal levels. However, we're not out of the woods yet. So right now, 10-year note yields still hovering at elevated levels at 310. This is Todd Colvin coming to you from the floor of the CME Group.